of the morning show. No one here is dressed up. We are not wearing costumes, but that's life. Maybe we'll wear them a little bit later during the show. Who knows? I'm Spencer Israel. We got JC here. We got Steve here. Great day for us on the morning show. Very excited for our guest today. Katie Stockton will be stopping by in about 20 or so minutes to just hang out and talk markets. And I've been looking forward to this one for a while. So very excited for that. We do have a lot to discuss on the movers front this morning, and a very interesting transaction going on in the hot corner. So a lot to get to. Good morning, chat. Good morning, Zach. Good morning, Sneh. I hope I'm saying that right. Do me a favor, hit that thumbs up. Let's bring JC and Steve on. Let's go now.
Happy Halloween, gents. How are you guys?
I could dress up. I don't hate Halloween like Spencer does.
Why do you hate Halloween, Spencer? You kind of have that natural Abe Lincoln look, you know?
Yeah, you're already dressed up, bro.
Thanks. No.
Yeah, if you were like taller and thinner, you could go for like Abe Lincoln. Had like a big hat.
I mean, and if my grandma had a wheel, she would have been a bike, but like I'm not, and she wasn't. So
you got the beard. We got the sweet beard. I was talking last week. I was like, I can't make fun of Spencer's beard because it's just sweet. Like Giancarlo's like, why aren't you ripping me for my hair? I'm like, but it's awesome. You know,
I'm going for a haircut and a beard trim tomorrow.
Beard's looking good. I'm impressed. I can't pull that off.
It's a Tyler Wood-like beard.
It is Tyler Wood-like beard. Yeah, you guys are in the upper echelon of beards. Strazza and I can't pull that off.
No, it's a sophisticated beard. I couldn't.
Strazza tries to grow a beard, and he just looks like a dirty man. You know,
I don't try to grow a beard. I forget to shave. Those are different things.
There you go. Two different things. Quickly, I won't be around for recess later today, so I just wanted to throw this out there for those of you wondering what to pair with your Halloween candy. You know. I mean, listen, you can do like a nice Pinot Noir with some milk chocolate. There's a lot of different like pairings you could do. But if you just want to keep it simple, you can go with sparkling wine, go with a demi-sec, right? And so a brut, extra brut, it's going to be much more dry. A demi-sec going to have much more residual sugar, less dry, right? You don't say sweet in the wine world. You say less dry. And the demi-sec, you're good to go. Sparkling wine.
All right, that's good. I think that's important for people, especially for you, because you have a Halloween candy and wine tailgate. But
that's right.
I want to talk about this most popular Halloween candy in every state thing that's been going around. Have you guys seen this?
Ooh, these maps are never right. I don't know how they get this data anyway.
So, what are the takeaways here? I mean,
do we have the map? I don't have the map.
Yeah.
Yeah,
let me drop it.
Yeah, Steve has it. I'm assuming it's wildly inaccurate.
You guys like candy corn? I like candy corn.
Hold on, here you go. Candy corn, thank God, is not on here.
You might be the only person I've ever met that likes candy corn.
Oh yeah, that's the reason that it's everywhere, because I'm the only one that likes it.
Candy corn, yes, awful. Milk duds, surprising. I don't know what a
milk duds underrated.
Mars bars. Where do you even buy those? What is that? Is that Pennsylvania?
Yeah.
Pennsylvania? Dude, your favorite candy is Mars bars. How weird is that?
My favorite candy is Mars bars. I like
hot tamales.
Like Snickers. Even my daughter knows. She's like, look, daddy, look, your favorite. I'm like, oh yeah, you know. Someone's paying attention. I like the Snickers. That? When I used to pitch back in the day, I used to throw 6 innings, 7 innings, and I would have one of those big Snickers bars, and I would take a bite or two, like in between innings.
What's surprising to me is like there's no Butterfinger on here, there's no Milky Way, but there's stuff like worms and sweet tarts and hot tamales. What's the best Halloween candy?
Peanut M&Ms is a good one.
Yeah, great candy.
Reese's. That's too much peanut butter for me. I could do one, but man, the country really loves Reese's. Damn.
I like Reese's. I get that.
Swedish Fish in Kentucky. Who knew? Who knew?
I
like Swedish Fish.
You know what though? It does pair well with a nice bourbon. So
Swedish Fish and bourbon.
That could be why.
Milk.
No, I'm
Airheads
making
in
that up.
Louisiana. Didn't see that one coming.
Milk duds is another one. I don't know what's going on in the Carolinas, but milk duds are gross too.
Kit Kat's in Cali, huh? The only state where Kit Kat is the winner. Didn't see that one coming either.
It's very surprising. That's my favorite candy.
I'm surprised there's not more Kit Kat on this.
I'm
map.
surprised there's no peanut M&Ms. What the hell, dude?
No, there's no M&Ms.
Yeah, there is. Look at Michigan. What's up with those? What's the blue M&M?
Oh, Florida M&Ms. Hang on.
Oh no, that's Wisconsin. Wisconsin knows what's up. Those pretzel M&Ms, they are delicious.
Oh, Wisconsin. Oh, those are pretzel M&Ms.
Wisconsin knows. Wisconsin knows what's up there. That's good.
All right.
I like
Snickers doesn't have more representation. There's no Butterfinger on here. Butterfingers are fantastic. Butterfinger's some of my favorite.
What is Utah? What is that? Some M&M variant that I've never seen before.
I think that's the caramel.
I've never
caramel M&Ms. Okay. They're good. They're money.
Okay.
I don't think
none of these things are part of the promo program.
Also, no Twix.
No.
Great point. Surprised there's no Twix on here. All right. Well, let's move on. I'm gonna have plenty Twix, Snickers, Kit Kats, and Reese's to eat because I'm gonna get no trick or treaters tonight. So I'm gonna have to eat all the candy.
Wait, JC, I know you have to leave a little bit early. I have a great recess for you, so remind me, and we'll do it right before you go.
All right,
because I have to go one. But let's get to the markets here. State of the market.
Do it. Hit it. I think let's talk about the S&P 500. This is a big one. I feel like we never start with S&Ps. Kind of a big deal. One of the most important stock market indexes on this here planet of Earth. And we've had some smart friends coming in here talking about 4,200. I've agreed. You broke below that last week. Quickly recovered. We're basically right there now, right around that 4,200. So this is the big one. There's a lot of market memory there in 21. You could see in early 22, resistance last year, resistance again early this year, trouble in the summer and the spring before breaking out. Just a lot of market memory here. So if the bulls are ever going to take over here, you're going to see a bid at these levels. These are logical levels for you to see some kind of bid. Now, with that being said, we have seen some kind of bid. Is it going to be something that's sustainable to really end the correction that we've been in for, 3.5 months, really, at this point? That's the big question. And then for me, the answer is in the dollar index, right? So throw that one up there. I think this is it. So for me,
yeah.
105.
What?
105.
Yeah.
105, 5.5, all that form of resistance,
105 and change, yeah.
So I think it's last week's lows? Does that work out to last week's lows in the dollar index?
I will tell you.
It's not.
Yeah.
It's not.
Yeah.
Last week's lows, right? Yep, last week's lows. So last week's lows get taken out to the downside, and it's over. I remember last Wednesday when we were in the Airbnb. I remember we were having that analyst meeting of ours, and I remember saying that we thought that 105, 105.5 level was important, right? We thought that going in. And then what the market did last week was reiterate that, yes, in fact, that is a very important level. So in other words, we thought something and then the market agreed with us, right? The market doesn't always agree with us. But I think the action early last week reiterated that, yes, in fact, those are key levels. And if the dollar index loses those highs, those former highs from earlier in the year, and the dollar falls apart, I think that is the bullish catalyst for stocks. I do not think that stocks are going to do well into the end of the year without that. I don't see it. I think it's a need for stocks to do well, not a want. And if the dollar index doesn't break down here, then you're not going to get this end of the year rally. Actually, it's probably going to get worse for equities, I think, right?
Yeah, I would have to agree with you. You do have interest rates coming off a little bit here today. Rates are coiling in a similar formation. So these probably move in the same direction.
Well, if they move in the same direction, how come rates were making new highs and the dollar was not? What's going on there?
We talked about this the other day. The correlations.
Do you still think it doesn't matter?
Correlations remain incredibly strong.
Right. So what does the dollar? What does the dollar know that the bond market does not?
Probably it's probably the other way.
Or what does the bond market know that the dollar does not?
I'm just gonna say that's the way I would phrase that question. Yeah, we'll see. A lot of action over in Japan today. Dollar yen making new highs.
What else is new?
So they are, I think, changing the peg and allowing rates to go over 1%. Wow. Japan. Don't go crazy on us now. But yeah, so you're seeing it now, the Japanese 10-year ripping towards that 1% level.
Nikkei likes it a lot, up 2% as the yen gets destroyed. Right? Nikkei, 660 points on Nikkei futures today. Wow.
I'm not seeing that.
You're not seeing Nikkei futures up 2.14% this morning?
No, I'm seeing 0.5%.
All right. I don't know what to tell you. NKD up 2.09%. Looking at it right now. Live quotes, baby. Let's go.
Oh, there it is. Okay. NKD. Oh, that's an interesting one. What's NKY then, JC?
Well, I guess it depends on what software service you're looking at, right?
I'm on TradingView. Yeah, all right. So nice move from Japan. And Japan's really been the leader. Cooled off a lot starting early summer. But maybe you see some sort of resurgence in that leadership. The, global
Nikkei right on that 200-day moving average, right? Almost like look at that. You see that?
I do. But it's also the highs from September 2021.
And it's also the lows from a month ago. Right?
We call this polarity. So nonetheless, a big level in Nikkei, getting a nice bounce here. I think it's important that international equities find some sort of a tradable low here.
Are we flipping the book long Japan?
I
don't hate it.
I don't know if it's ready, but that would be an area that I would look to, right? Looking for international equity exposure. Japan would be the top of that list.
You buying the EWJ or the DXJ? Or it doesn't matter.
Probably shut up. I would probably buy the EWJ, to be honest, at this point.
Because why? Because if equities are going to rip, then the dollar's falling apart, and you're going to get both sides.
That's an easier bet for me to wrap my head around, right?
But we could very easily be in a situation where the yen gets slaughtered while with an equities getting showing strength into the end of the year, and the rest of the dollar getting slaughtered.
It has been. That has been the case. The yen has been getting slaughtered nonstop for 3 years now. So
when is the yen not getting slaughtered?
No, it wasn't always this way. You could zoom out on this chart. The yen actually was something that people could buy and not sound crazy back in the day.
What about these CTAs? Should we care? What about these CTAs? Man, look at that short exposure. They're not covering at all. They're pressing their shorts. Man, when shorts overstay their welcome in a bull market, I've seen them getting carted off on stretchers. Remember these silly Perma-Bear ETFs blowing up at the beginning of the year with their they're spending more time on Twitter Spaces than protecting their portfolios. Remember that? This smells like that, right?
You can literally look at this chart, and I'm picturing the S&P in my head. You had a key bottom 2015-16, another key bottom late 2018, and you see these extreme readings similar to the one that we have today. Problem is
with the COVID, this is worse than the COVID low. The COVID low was pretty aggressive. This is even worse.
The COVID one doesn't even show up as much as the others. Problem is today, if you look at the price structure, we're not at a bottom. We've been rallying all year. So isn't that strange to see a sentiment reading like this accompany a stock market that bottomed 12 months ago?
Yeah, well, that's what I'm saying. Just a little correction that lasted 3.5 months during a perfectly normal time of the year for the markets to correct. And these commodity futures traders are pressing their shorts very aggressively.
But sentiment, a lot of these sentiment readings, you could look at the daily sentiment index, the DSI, also pretty extreme reading right now. They are readings that you typically see at a major bottom, like the one we had last year.
Yeah.
Not a correct.
It doesn't have to be a major bottom. It could just be a bottom.
These are all major bottoms.
Are they?
2018, COVID. And then it's like today, NASDAQ had its best first 6 months of the year ever. We were talking about how great the market was doing, just a few months ago.
That's right.
So it's a little strange to see this kind of a negative sentiment reading when we are not at some like washout bottom.
Maybe this is a major bottom. Maybe we look back on this 3 years ago, be like, wow, remember that fall 23 bottom? Wow, what a great buying opportunity. I mean, I don't know.
We won't. From a price perspective, we'll never look at the S&P chart if it bottoms here and say that was the bottom. No, this was a correction low. The bottom was last year. My point is these extreme sentiment.
If you're looking at the S&P 500.
Yeah, I am. That's what
right. But if you're looking at the Russell 2000, if you're looking at the value line index, some of these have struggled. The S&P 500 has held in really well because, right? So has the Dow. It's held in even better.
Forget it. The point remains, you tend to see these extreme sentiment readings at major bottoms. We're not at a major bottom. We had a major bottom 12 months ago. This is a correction low, if anything. So this sentiment reading really doesn't jive with that kind of a price structure. And to me, it's strange. If you look back at a chart of the S&P and look at these other extreme readings, you'll see major bottoms. You don't see that today. So that's the only point I'm trying to make.
All right. Was early 2016 a major bottom or was it just a correction?
Look at the chart. You would draw an arc there, right? You would draw a nice little base there.
Just like hindsight, because it ended up being a ridiculous rally from those lows. We had a 2-year rally from there, but you didn't know that at the time. So what if we have a 2-year rally from here?
I'll mark up the chart because I don't know why you're having such a hard time visualizing.
Because I think to your point, like it's not like we've been in this like long drawn out bear market or whatever. Quite the opposite. But the fact that they got this bearish, this short, this fast, doesn't that speak to just how scared people are so quickly? Isn't that a net bullish signal?
Sure, you would think that. That's not what I'm talking about, though. It's just strange to see something like this at a correction low. I'm surprised.
Agreed. Isn't it strange how bearish these guys are in the middle of a bull market? I agree. That's strange.
I know you got your bull market goggles on. I'm just kind of trying to think outside the box here. This is a little bit unusual.
I agree. Can we agree on that? We agree that's unusual?
Well, wouldn't you also say, JC, that the bull market has been losing steam here?
Has the bull market been losing steam because we corrected during a perfectly normal time for seasonality?
100%.
It doesn't matter if it's normal or not. Down is down, right?
Down. Listen, when you weigh all the evidence, there's no evidence whatsoever that we're in a bear market. The majority of the evidence.
I didn't say that now.
Point that we're in a bull market.
I didn't say that.
There are certain breadth readings, like the percentage of stocks above the 200-day, that if you look back at that chart now, you can go back 30 years. You never would have seen breadth revisited such a negative point.
Why? What did we get to? 25%?
Dude, we're close to 15 right now. So that indicator is close to double dipping. Never seen that before in a bull market. So we're starting to see things where we're going to be saying more and more, if this is not a new bear market, well, we've never seen this before.
The percentage of stocks on the New York Stock Exchange above their 200-day moving average right now is at 27. Yeah. Nowhere near bear market levels.
I didn't say bear market. I said the bull market has been losing steam.
It's a simple point that it's never revisited that low of a level after bottoming out at 15 and taking off. Just zoom out 30 years. I was looking at it yesterday. So this would be the first time ever for that indicator to do that. I'm not saying that would.
We dip below 30. We dipped below 30 in 2014 and absolutely ripped from those levels. We dipped below 30 in 2010, absolutely ripped from those levels. So yeah, this is not unprecedented. This is pretty normal.
Yeah, I'll tweet the chart out so everybody can see it. This is totally unprecedented. Sure. You're just clearly not understanding what I'm saying.
I understand completely what you're saying.
But also, normal or not doesn't really matter. right? Like the market, the performance is the performance.
Spencer actually is right. We see something that's never happened before every day.
Yeah, it doesn't matter.
I'm talking to both of you. I'm talking to both of you.
Yeah. Okay, fine. Listen, at the end of the day, none of us, the three of us here, none of us know what the market is going to do next month or next year. None of us know. All we could do is weigh the evidence, and people are like, "Whoa, technical analysis only looks at information from the past." It's like, well, if one of you out there, one of you wise guys, can provide me with information from the future,
okay,
I would be happy to take a look. But we are forced to deal with information from the past.
Do you know what somebody would say to that?
Seems perfectly normal.
Do you know what somebody would say to that? They would say, "I have information from the future. It's called forward-looking estimates." That's what they would say.
That's the dumbest shit I've ever heard in my life.
I'm just saying. I didn't say I would say that.
If anybody ever tells you that, smack them in the face. Tell them JC sent you.
I would say that's
forward-looking estimates. Those are also people's opinions that only have information from the past. Also, by the way.
So let's just keep the.
Come on, Spencer. You're better than that.
Let's just hold on, Spencer. Let's keep the discussion honest here. I guess I have to point to data if I'm going to make a point. Throw up chart 2, just to illustrate how severe this deterioration is. We made a criterion, 4 things that we thought should be in place if there's a true reversal and the new uptrend underway for a component. And then we're measuring all of the stocks in the S&P 500 here. So the green line in the lower pane is saying all 4 things that should be in place. So 200-day moving average sloping up, bullish momentum above a certain high. All those things are in place. The green line is measuring that. The red line is if none of those things are in place. So definitely not a reversal pattern, definitely not a new uptrend. Back in July, at the highs, we were at about 35%, almost 35%. 35% of the stocks in the S&P 500 had completed reversal patterns, and the trend was now higher. Today, that number has fallen to 13%. We have not seen it that low.
What is a reversal pattern?
A base. So a rounding bottom, right?
How do you define that?
This is in the CMT textbook. I don't need to tell you what a reversal pattern.
As long as it's in a textbook, then it must be true.
Edwards and McGee, it's in there too. It's a lot of places.
How do you quantify a base like that?
So David Lundgren does something similar.
Yeah.
And
so how do you quantify? Explain to me. I would love to hear that.
It's written on the left-hand side of the chart. 200-day moving average slope is rising. Momentum is in a bullish regime. We're above the August highs. And then I like the relative trend. So just to be clear, you are not buying stocks right now? No, haven't been for the past few weeks.
All right. I will be adding to the positions that I started putting on over the last few days, by the way.
I can't help you then. I don't know.
I'm not asking for your help.
I don't know what.
I don't need your help. I'm a big boy. I can enter the positions on my own. I can pick up the phone call from my margin clerk. I don't need you to take my calls.
Yeah, no, I wouldn't. So anyway,
all right, I'll be adding to my positions today.
The amount of components in the S&P 500 that have 0 of these 4 boxes checked is at its highs, 55%. We have not seen it this high since we started doing this. And the amount that has 4 out of 4 boxes checked, which mean a completed reversal pattern, a new uptrend is underway, has plummeted to its lowest level, 13%. So we're continuing to monitor stuff like this, but this is just another way of illustrating how ugly the breath is out there. And just what
so in your opinion, since breath is so ugly, what are we shorting?
I think there's plenty of opportunities in financials, real estate. I think you want to.
So you're shorting financials and real estate down here, huh?
No, I'm not shorting financials and real estate, but
if breath is so bad, why aren't you shorting?
Our shorts have been working great. Some of our best trades this year were shorts.
All right. I'll buy more stocks. Let's get Katie in here. Let's see what Katie thinks.
We got Katie Stockton,
one of the best in the business.
Katie, you ready? I think
so.
Ready. She's always ready. All right, I'm bringing her on.
Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Katie, welcome to the show.
Hey, JC.
Is she on?
Thanks. Sorry, I'm a little bit late. the day's already gotten away from me. I guess it's Halloween, right?
That's it. Listen, it's not. It might be Halloween, but it's also the last day of the month. That means we get fresh monthly candles tonight. Very exciting.
That's exciting. We definitely sort of live for that. We want to see how all these MACDs look at month end, and it's pretty tenuous, as you know.
we were just having a debate, myself and Steve Strazza. You know, he thinks market breadth looks terrible. You know, he's not convinced that this is a bull market. I think that this is a perfectly normal correction. So far, I think it's a perfectly normal correction during a perfectly normal time of the year for markets to correct after the greatest 6-month rally in the history of the NASDAQ. I'm looking at some stocks in certain sectors that have been showing relative strength, and we've been putting money to work from the long side over the last week, as opposed to pressing shorts like those CTAs have been doing in recent weeks. So I would love, for those of you who don't know Katie Stockton, one of the best in the business, no doubt. I've learned a lot from you over the years, so I appreciate that. Would love to hear your thoughts.
Of course, JC. So I think you guys are both right. I mean, breadth has definitely been terrible, and yet it's still a cyclical bull trend. But it's pretty tenuous here too, in that the S&P 500 is testing a very key support level, and that's about 4180 in our work. You can probably guess where that comes from. It's a Fibonacci retracement level. And if it's broken decisively, which for us means 2 weekly closes below, so that's pending confirmation this Friday, essentially, well, then that effectively tells us that the correction is kind of worse than that. It's actually the potential start of a cyclical bear trend, or at the minimum increases risk intermediate term to secondary support, which for us is just below 39.20. So it is a sort of a lot holds in the balance of this week's trading, in that we have, we need to absorb an FOMC announcement. We need to absorb Apple earnings. So a lot can happen in just 1 week. And of course, we have month-end dynamics today. So there's a lot going on that can affect the volatility behind the market. And our hope is that we see the close above 41.80, and it makes last week look like a big shakeout, which would be a bullish sort of test of support, and then release the market to see sentiment improve from what has been really pretty bearish from a contrarian perspective, right? But if we do see that confirmation, it would increase risk. It doesn't mean you go and sell everything straight away, but it does mean that you're, maybe better off being a better seller. And in our work, it makes, 2024 sort of, it holds in the balance of really what happens this week. So we're scrutinizing the near-term price action. The breadth is definitely an overarching concern. The cumulative advanced decline line took out some major support, and yet then when you kind of look at it from more of an overbought, oversold perspective, it's really incredibly oversold. So you would expect breadth to kind of snap back in here, and when it does so, it can do it really kind of violently. So, we could have that potential for a really big relief rally is what we're thinking, even, if we do see the confirmed breakdown.
No, Katie, one thing that stood out recently is just, 2 oversold readings just this month in the S&P 500.
And what specifically? Because Katie looks at a few different oscillators.
So the S&P 500, but you'll see it in other indexes and sectors.
No, but what indicator?
Oh, the daily RSI 14. So you want to speak to that a little bit? I don't know what you're using to measure momentum. I know you like the MACD a lot, but where are you seeing oversold readings, and what are you using?
Yes. Yeah, and I'm not an RSI user, but it's not because it's not helpful. It's because I use the stochastic oscillator, and it's not dissimilar. We like to use weekly oscillator, and we like to use it on a 12-period time frame, not because that's like the end-all answer, nor is any parameter for any indicator, but because it just eliminates sort of the right amount of noise for our work. And we've seen those intermediate-term oversold upturns from earlier this month give way to retest, right? So that's a kind of second oversold.
We're losing Katie.
It's not uncommon for these oversold metrics to do that, right? So you get sometimes positive divergences where the stochastics will make a higher low and prices will get lower.
Oh, Katie, we're losing you. You guys all losing Katie?
I'm having a tough time.
Yeah, Katie, you're coming in and out.
Okay, I'm going to close out my Bloomberg.
Oh, that Bloomberg, it slows everything down, Katie,
Optimo does that too.
Well, it depends how much data you're downloading.
Hopefully this will work. I know the Bloomberg, but
No, we lost you.
I depend sort of my lifeblood. Can you guys hear me now?
I think you are back.
Okay, good. So
Great.
what we were talking
Can we
about.
dive in? I was
Go
wondering
ahead.
if we could dive into some sectors. We talk broad markets, we talk S&P 500 and everything like that, but that's just not the real world, right? Like we're looking at individual equities, we're looking at individual sectors, we're trying to put money to work in specific places, right? I know you think in a very similar way. So we're not just blindly buying 500 stocks. If you are right and sentiment has gotten a little bit too extreme, breadth, I wouldn't say at washout levels, but you can argue certain breadth indicators are pretty extreme. Where are you looking to put money to work going into the end of the year, into January?
Yeah, I mean, it all really depends on whether we get this confirmed breakdown or not, right? Because if we do see a confirmed breakdown, then we'll want to be a bit more defensive, and defensive in overall positioning, not just sector positioning. Whereas if we have that stronger close this week and we have what we think is a bit of a shakeout for the market, certainly the time of year, JC, as you mentioned, that it is very prone to those types of sort of reversals up. Then we'll get more aggressively long, and we'll be buying technology. We'll be buying the former leadership, like the mega caps, discretionary technology, communication services. Those are all in the large cap front. Those are all in our ETF TACK. We also will be, looking for opportunities farther down the market cap spectrum. So almost less about the sector and more about kind of the factor. We like to build growth exposure, so growth versus value when we feel like the tape is strong. So if we get that rebound this week that we're expecting, then we'll be interested in buying growth and maybe not going really far down the market cap spectrum, but somewhere, at least into the mid cap realm
So
to
as long
see if
as
breadth improves. Yeah.
So as long as it's a risk on tape, you guys start to overweight growth more and more. Is that what you're saying?
Yeah, I'd say, I mean, as long as the trends are favorable for growth, which they are. So if you look at the ratios there, even the small cap growth to value ratio, while it's pulled back a lot, it still looks very much just like a correction within an uptrend to us. So we'll be, looking to add exposure if the market allows us to do that. Much longer term, we have to think somewhat in different terms because, talking about positioning into year end is one thing, but from a long-term perspective, we're neutral. We really feel like that market has some pretty major challenges from a technical perspective long-term. All you have to do is look at things like the monthly stochastics, the monthly MACD, the monthly cloud model, all of these long-term indicators, which have not improved in October, unfortunately. These long-term gauges are, I'd say, neutral at best. Most of them even start to look like they're rolling over. So what it requires from the market to see improvement is like a very quick snapback, like a proper relief rally to show improvement in those long-term metrics. So we're more neutral long-term. We can feel confident in shorter-term exposure, perhaps if we get that non-confirmation, the breakdown. But longer-term, we're going to need to see those metrics really improve in order to go from what we feel like is an environment in which the fixed income exposure should be higher than average, right? Gold exposure, silver exposure should be higher than average. Cash exposure should be higher than average. So bigger picture, sort of from an asset allocation perspective, we feel that we should still be managing risk, right? Because of those long-term gauges, but always within that context, of course, in our research, especially, we're focusing a little bit more intermediate term. And we feel, if we have this short-term opportunity from the market, we're going to jump all over it.
Katie, how do you define intermediate? There's a lot of definitions for that.
Yeah. So I usually say it's kind of in the 2 to 4 month range, like kind of centering around 1 quarter. And so you can see that with that in mind, I lean a little bit more short term in my work. So when I say short term, it's anywhere from say 2 to 6 weeks typically. And I'm not a day trader by any stretch, but a lot of the indicators lend themselves really very well over those timeframes. But in terms of investing, right, we really believe in a long term outlook. Right. We don't want to over trade. There's no real benefit to that. So we believe in asserting a long-term position when the market affords it. And unfortunately, it's been a really difficult market to do that because you have a lot of things that are sort of non-trending, right? And then you have, from an asset allocation perspective, sort of the double coming off the double bear market cycle, right, in treasuries and equities. So that it's a challenging environment to take that kind of long-term view. But I think that that's usually the right thing to do, and probably will continue to be the case over the next whatever 20 years, right? So that's what we would try to do in our investing. And then you can always take like your core holdings, right, and then supplement them when you feel like the market's firing on all cylinders. So I always tell people, have your core holdings. Ideally, those core holdings are looking, like they're in a long-term uptrend, or at least better than the broader market. And then you can supplement it with a little bit more opportunistic sort of ideas. And that's what we're doing. We have a Substack newsletter that we just added to sort of our research suite. And in that, we're just throwing out ideas that we expect to work short term, but also ideally have good long-term prospects. And those are the types of ideas we would use just to supplement our portfolio and be somewhat maybe non-committal to them depending on the environment.
You mentioned gold briefly. Can we talk about commodities? Because Katie, the way you and I learned it many years ago was that there were 3 asset classes. It was stocks, bonds, and commodities. And then a funny thing happened, that commodities were in this long bear market. All these new kids came into the trading world, and everybody just forgot all about that third one, and it just became stocks and bonds. But you remember when there was a third asset class? Remember those good old days?
Yeah.
Is there? How do you think about that?
And I also think technical analysis as a discipline lends itself so well to commodities, right? It's not really our area of focus here at Fairlead, but my background where I started as a technician was at Dorsey Wright and Associates, point and figure shop, right? And I'm sure a lot of people know it. And they had a fixed income portfolio, of course, but it really were very commodities focused for one of their portfolios. So I learned about it there, and I saw the benefits of charting those markets, right? Without really even understanding the dynamics, perhaps between orange juice futures and coffee and what have you. It sounds like breakfast to me. I really found it fascinating, and I think there's a huge potential to apply charts in that arena. We do tend to focus really just on gold and precious metals. We highlighted copper as an example in our morning note, just because people care about it from more of a macro perspective.
What about energy? Energy too.
And of course, crude oil and nat gas I was going to add as well. So we cover crude oil in particular and gold in our weekly report because we know how important they are. And gold is also a component of our ETF. So we have the ability to invest in gold via GLDM, which is like the mini gold shares trust. And so we believe it's a great sort of diversifier, right? Something that can give you something that doesn't look like the S&P 500 or thankfully like a treasury bond. It gives you that diversification. And I think there's real potential in gold. If you take a step back, it's a very long-term trading range. And that trading range, within it, we've seen momentum sort of improve as you've seen very recently. So it's kind of reversed an intermediate term downtrend within the context of this big, wide, long-term trading range. The upper boundary of that range, for those that are tracking it, it's about 2063 per ounce. So if you see a couple good solid weekly closes above that, that's a major gold breakout. Even if it kind of holds in this range, we believe in it as a long-term investment, but that would be a nice catalyst for gold prices. And I don't see the sort of like one-for-one relationship, like, okay, well, if gold is rallying, that's, indicative of people chasing out safe havens. And I mean, that came up recently. Yeah, I see you shaking your head. It's like, okay, well, if that's the case, then why is Bitcoin ripping at the same time?
I know, but Katie, in the 2000s, we were in a roaring bull market in stocks, and gold was outperforming that entire time.
Yeah, that's what. So we always think about historical correlations as being just that. Like they do hold up over long periods of time, right? So we do seek relative performance from gold from treasuries or fixed income and cash, of course, versus equities and weaker equity markets. We do. And over, periods of say 3 to 5 years, you should see that manifest itself in your portfolio. But if you're talking about a 3-month, evaluation metric, it really, it may not hold. I mean, we know that the correlations even between the dollar and gold break up at times and break up pretty dramatically. So I'm not, one to kind of make those takeaways from a short-term perspective. But I listen, for gold as an investment vehicle, I think it's pretty promising, as long as it kind of either maintains this momentum shift within the range, or especially if it breaks out from the range.
Strazza gets upset that I always steal all the questions when we have good guests on. Katie fits the category of a really good guest. Strazza, am I stealing all your thunder, or do you have one to throw at her?
No, I think it's been a good conversation. So, Katie, if there is going to be a year-end rally and the data starts to support that, where would you want to be? Is it just mega cap growth, big tech?
Yeah, I mean, I think it is growth versus value. I think it is tech versus everything else, right? And listen, I mean, that's where I find most people are excited to invest anyway, right? So I get probably the most questions about technology stocks, cloud computing, AI, et cetera. So that's where people like to do their homework fundamentally. So I do feel like that's probably where some good potential is. But you can really kind of generally seek out more high beta exposure to supplement those core long positions which may be more conservative. I don't think you do away with any of those, but I think you could kind of build on them with more high beta exposure. You can also find that globally, right, outside of the US, in emerging markets for one. I would not be opposed to, revisiting some emerging markets that feels like investors have kind of left for dead. If we do see this turning point that is very characteristic of year-end positioning. I mean, the seasonal work, and I don't make recommendations based on seasonal work, but when it enhances what we're seeing, we like to see that, right? So the seasonal work is really very favorable and would support that kind of relief rally.
And emerging markets, like, do you mean China, or are there or ex-China, right? Big difference in conversation, right?
Yeah, I mean, I would say including China. We highlighted the Hang Seng the other day. I know it's not a place that we're getting a lot of questions about right now, but from a technical perspective, the oversold condition is somewhat compelling. I mean, it's an oversold condition it is within a broader long-term downtrend, but you can make the case that some of these markets, including China, are in longer term basing phases. But we can say the same thing about the ARK-K ETF, right? It's a pretty nasty intermediate term down move, but you could still argue that this is a retest process within a longer term base. We just really need to see a near term reaction, because if it keeps going lower from here, well, then key support is going to be taken out.
I want to give a shout out to Katie. Katie's ETF TAC, TACK, Fairlead Tactical Sector Fund, TACK, $220 million in assets under management for a new fund. Congrats, Katie. That's not nothing.
Thanks, JC. I know we launched it in March of 22, so that it was a sort of a proof point for the model, in that we had to manage risk basically straight away in the portfolio, and really were able to outperform nicely in 2022. And I think that helped build the interest level and the traction. And then beyond that, we just tried to kind of create an episodic view around the TAC ETF in our research and through a monthly letter that we offer to investors.
I love it. Congrats. Last question. You talk to a lot of people. You look at a lot of charts. I know you. You know what's going on. What do you think people are just missing? What stands out to you that nobody's talking about, out of left field, that you're just kind of like,
Okay, here it is. So, and this is really, I feel like we're being a little presumptuous here in terms of our indicators, but TLT, we all know the sort of long-term treasury bond ETF, very popular. It's been trending lower since COVID. And I mean, really decisively lower. It's like this very persistent downtrend in treasury bonds. And we've tracked the DeMark indicators, as you know, and the DeMark indicators are designed to identify trend exhaustion. So they're counter trend in nature. You'll see a buy signal when something's going down and generally looks pretty terrible and vice versa. We had a sell signal on the monthly TLT chart in April of 2020. And it proved, of course, to be really very timely. And we haven't had a countering signal until potentially tomorrow. So we're talking about a potential countering buy signal from the monthly DeMark indicators for November, which of course is tomorrow. And that would be kind of a big deal. So we're being presumptuous because we don't know if we'll get the signal. There are a lot of metrics that need to sort of be satisfied for that signal to pop up. It seems likely to us. And then we also won't know if that signal is sort of locked in until the end of November. So we're getting ahead of something which we don't usually like to do. We don't want to anticipate the anticipators, but there is a potential for that signal. And it would be something that we think the equity market would receive well, because it would mean that we should see stabilization at a minimum, or even a counter trend move that's somewhat substantial for Treasury bonds. And then, of course, the reverse from Treasury yields, which have really been the challenge for the equity market of late, and in a duration of maybe 9 to 12 months. So it wouldn't reverse kind of the secular trend necessarily. We wouldn't expect it to, but it's enough of a counter trend indication that I think the market would really welcome that. So that's something that we have our eye on that I don't think a lot of people are talking about, but we'd certainly welcome it if it happens.
Yeah, I mean, $120 trillion asset class literally crashing is going to infiltrate other areas. I mean, right?
Yeah.
How can it not? Right? And we've seen that.
DeMark signal or not, if you look at something like TLT, what a logical place for buyers to kind of step in here. Same place that the fund bottomed in 2002, 2003, 2004, 2006, like over and over and over again.
They call that support, Katie.
Yeah, I've heard of support.
Potential support. Right?
And the other thing, and this is maybe getting a little technical, but just back, Steve, to your point on the oversold retest. If we do see stabilization, guess what? All of a sudden, we're going to have a lot of positive divergences unfold, because TLT has made a lower low long term as the MACD is kind of just held in there, right? So all of a sudden, the MACD histogram is going to tick up. And so you could see that even just a couple months of stabilization there is really going to improve the look of those long-term indicators.
For sure.
Reminds me of natural gas in 2012, when I'm like, we have to get a divergence here on these new lows. And sure enough, we did. It reminds me a little bit of that.
Well, what about right now? Natural gas looks kind of, I mean, there's a little bit of a rounded base. I don't know. We'll see.
Look at Katie talking about the Widowmaker, a little natural gas there. I like it. Kate, Spencer, it took too long to get Katie on the show. Get her back on soon. Spencer always takes too long getting the best guests on. Come on,
I
Spencer.
can do that. Thanks a lot, Katie.
Thank you, Katie.
Good to see you guys. Have a
Keep
great
up the good work.
Halloween.
All right.
TACK, Katie's ETF.
All right, JC, I know you have to hop early, so before you leave, I just wanted to do recess because I think you'll appreciate it. I'm not gonna run the bumper. We'll do it later.
In the middle of the show.
Yeah, whatever.
We do what we want. This is America.
Friday was a bittersweet day. We have to say goodbye to technical analysis forever, unfortunately. It's sort of the last day for technical analysis, for fans of technical analysis. I am, of course, referring to the horse called technical analysis.
Sparkle Blue, who begins to come alive as they come off the turn and enter the stretch. And it is Technical Analysis who has the lead. Technical Analysis. Down on the inside is a Bout Cachet. Fluffy Socks is coming on now. And on the outside, it is Sparkle Blue with favor. Technical Analysis is still there. And Technical Analysis has done it in front-running fashion. And it's a 4-win Friday for jockey Jose Ortiz.
So that was
real?
That was the final race in the storied career of technical analysis.
Who knew?
Well, you know now.
I know now.
That was the Athenia Stakes at Belmont Park here in New York. That was a race for that was a 9-furlong race for fillies and mares that are 3 years old and up. Technical Analysis has now purchased over $1 million in its career, and it is time to go to the farm and breed some horses. So that's what's going to happen.
Technical analysis pays well, and now he's just going to be a stud for the rest of his life.
Technical analysis is going to be a stud. It is expected to sell at an auction in next week, actually, and it's going to go and make some babies and do that for the rest of its
Where do
life.
I sign up for that?
Yeah, right, exactly. So,
with this clever.
Goodbye, technical analysis. We hardly knew you. We'll miss you, and that's it. That's all I had to say. So,
all right, guys, I have a Halloween parade, a pre-K3 Halloween parade to attend to. So I'm gonna take a little break, and I'll be back. I'll be back in an hour.
All right.
Try not to break anything while I'm gone. All right, guys.
Good riddance.
Adios.
Bye.
Steve, do you have thoughts on the end of storied technical analysis career? Because I it's a bit of a bummer that we can never see it again. Talk about it again. Frankly, I mean, it's over.
So horse racing, for me, is by far the worst sport in the world. I hate baseball. I hate a lot of sports, but horse racing, I'll just never understand. I think it's terrible. I think it's like barbaric. I think it's stupid. These horses are getting shot out here. They break their legs.
No one's getting shot, man.
They call it the most exciting 2 minutes in sports. It is the most boring 2 minutes in sports. People get all up in arms about this Kentucky Derby thing. I hope I never see another Kentucky Derby. I don't care about horse racing. I think the technical analysis thing was cute. Good job.
I will say I went to Churchill Downs. Was it last summer? Summer of 22. Fantastic. I thought I'd be there for an hour. I was there for 4 or 5 hours. It was awesome. Awesome. Got a whole tour.
Listen, I've done it. I've done the whole thing. I've gone to the track, bet on the horses. We used to do that.
Yeah.
I don't think I'll ever do it again. I'm not interested.
All right.
You can bet on real sports now, so you don't have to go bet on horses.
It's true. You can bet on real sports now. It's fun. Yeah. Anyway, I thought you guys would appreciate that. It's not actually, believe it or not, I've actually heard of that horse before, but I happen to have seen it over the weekend that it won that race, and I forgot to do it yesterday.
And I've gone to things. I get it. It's a big culture. In South Carolina, I did the thing. I had to wear a big funny hat, and we went to the horse thing. I get it. I've done it all. It's a huge thing. It's like a giant festival. Everybody's so excited. It's stupid.
Okay. All right. Hey, look, not for everyone. All right, not for everyone. Okay, let's move on here. Talk about other stuff. Steve, we had some very interesting earnings reports to discuss here. Now that earnings report Grump is gone, where do you want to start? We've got on semiconductor from yesterday. We've got all right. Let's start with ON here. So this was a report out yesterday morning. Earnings were fine. The guidance was light. It wasn't like it was the worst guidance I've ever seen. It definitely was light. It wasn't horrifically bad, but it was certainly below estimates. Anyway, I guess when you are in a hyper growth industry and you come in below estimates, the market hates that because ON got punished yesterday. Do we have that chart? I think we do.
We have an on chart.
Yeah.
So they make the chips for something solar for EVs. They make chips for Tesla. Did you see this?
Yeah. Yep.
So Tesla stock got killed again yesterday. It's been getting killed every day.
Mm-hmm.
Panasonic cut guidance for battery output. ON's guidance, forward guidance was crap too. And that was a read through for the market. How good is the market as a discounting mechanism? The market read right through those two reports and hit Tesla stock. I like to see that kind of stuff.
I mean, yeah, there are institutions. This is what they do. They trade relationships, right?
Fantastic.
These things can be quantified. So
you also had the strike ending, right? Which of course, it was going to end eventually, but you would think that's also net bearish for Tesla.
Perhaps I don't know. Maybe
they made a deal. UAW made a deal. So we've been talking about this for the past month and a half now. So the strike is over. Americans are going back to making cars again. A lot more to do it.
Okay, so the strike lasted pretty much exactly 6 weeks, and in that time, this is as of yesterday, not this morning. In that time, the S&P was down about 6%. Stellantis was down 4.8%. GM down 19%. Ford down 22%.
Stellantis didn't feel it like GM and Ford.
No, that's not what they said this morning.
The stock didn't feel it as much as what I'm saying. Why? What they say?
Maybe. Well, they had earnings, so they had to come out and say that the strike will cost them about $3.2 billion in sales. So,
I mean, yeah,
not nothing, right?
These are companies that can't afford to lose those sales. So I think this hurts them in a big way for years and years to come. I think this is a major setback. I think this hurts them from an investing standpoint and just a viability standpoint. These are companies that are literally scraping and scrounging to get by, and their cost structure and their margin outlook is getting worse by the minute. I don't know how it goes for these companies in the future.
GM said the strike will cost them about $7 billion over the next 4.5 years. Ford said the strike will likely add about $800 to $900 to the price of a Ford.
I would love
for consumers. So
I would love to know how many contracts Ford lost, fleet contracts. I don't know if that's something they report, but I would love to know those figures.
Is Ford still the supplier of like police cars, right?
Everywhere.
Yeah, like every police car.
That's such a big part of their business. They're in with governments, agencies, all that stuff. Yeah.
Well, the biggest requirement for that is the ability to make cars fast, and Tesla can't exactly do that now, can they? So, a lot of cars. I mean, they can make cars fast, but they can't make a lot of cars. So, okay. Let's talk about like.
Let me just one more point on semiconductor. Right, semiconductors, critically important industry group. Pro-cyclical industry group, the kind of stocks that you want to see do really well in a bull market, and they have been. They've been some of the leaders, right? On Semi, one of the best semiconductor stocks out there, right? Zoom out on the chart for the past several years. This is a major leader. To see it, getting shot like this on earnings, and this is absolute tank on earnings the other day. It's not good to see the leaders really falter like this ever.
So if you've been a leader and you say anything that is remotely concerning, you'll get punished, right? And that's what happened here yesterday for On. So
yeah, another thing I'll say just about this one, I don't like stocks that are too intricately,
connected,
intertwined, with other businesses. I don't like these like direct derivative plays. I remember Skyworks back in the day with Apple. That was a bit.
It still is.
Yeah, I don't like that. Right? Give me a nice diversified customer base and a business that's not going to fall apart based on what one other company does. I don't love that.
All right. I mean, there are a handful of companies out there that derive most of their revenue, or maybe not most, but a majority from one contract. Speaking of I mean, Apple is of course.
I don't want to own those businesses. They literally have to disclose this as key business risks in their 10Ks about losing contracts with one company. So it's an undue risk that you don't need to take on, I think.
All right. I feel like the chip industry itself is incredibly incestuous. Everybody supplies everybody else. They're all connected. They're all tied together.
Speaking of which, a lot of headlines this week about NVIDIA China. Guys, it's priced in. It's anybody who knows anything who's buying the stock anytime this year is pricing in the risk that they're going to lose China sales.
This was disclosed months ago. I feel like
we've been talking about this for a year. So if they lose all those sales, I wouldn't expect a giant reaction from the stock. I think the stock should be priced by the market and probably is priced by the market in a way that those sales aren't there in the future.
I don't know. Don't underestimate the market's ability to not remember headlines from months ago, right? And
a stock like NVIDIA that's this super liquid, everybody's talking about it, everybody knows about it. The market tends to do a damn good job pricing it. That's why its earnings reactions have been pretty muted this year.
Okay. All right. Yesterday, we talked about Decker's Outdoor and how everyone's buying all these shoes, right? Well, they're not buying every brand of shoes because we had earnings from VF Corporation after the close yesterday. And
isn't that like Tommy Hilfiger and Polo?
Well, it was yes, you're right. But it was a disastrous report, and they blamed it on Vans.
Again.
Which are skater shoes, right?
How good is the market at pricing this crap in? There's a reason it looks this way.
This was an absolute doozy here. So VF Corp is now halfway through their fiscal year. They did lower their full year free cash flow guidance from $900 million to $600 million. While they were at it, they cut their dividend by 70% from 30 cents to 9 cents. Just an absolute, just get all the bad news out in one shot is what this was. So, obviously, stock is down about 8% today. As we open up here, but we got really rough go of it. This thing was, one of the darlings of retail, frankly, for a long time, and obviously that chart kind of says it all right there. But
do you know what the dividend yield was before they cut it?
Let's see.
It probably got pretty fat just based on the price action.
Let me see here, because it's possible that my data source didn't update from that yet. So 7% is what it was.
So this is.
Yeah.
So they cut their dividend by 70%. It was a 7% yield. You could look at that yield, look at this chart, and literally make a reasonable conclusion that it won't be paid, that dividend will be slashed, right? 7% dividend on a retailer on a chart that looks like this, that's the market telling you that's really not a 7% yield. It's never going to happen. Now, after the 70% dividend cut, the yield is much more in line with the market average, 2.1%. Yep. That sounds more like it, right? So again, slowly, gradually repricing. Now the dividend getting back in line. Got to wait for evidence of a tradable low unless you want to be like JC, just come out here trying to catch falling knives. This is a stock you would not want to touch with a 10-foot pole right now.
Yep. On the other hand, here's a company with a great report overnight, surprising myself and many others. Pinterest. This might be This might be the best report for Pinterest like ever.
Yeah, let's talk about it. Give me the numbers.
Yeah, EPS beat estimates 28 cents versus 20 cents. Revenue beat estimates $763 million versus $743 million. Yep. Global monthly active users up 8% year over year. They raised their Q4 revenue guidance, and they're profitable.
Yep.
I'll be damned.
Yeah, and then to make it even sweeter, you got I think Paul Singer and Elliott Management involved in this one, very involved. They have a pretty big stake. They are activists in this name. On today's reaction, we're up like 13-14%, fading a little bit here. Yeah, you got a solid green candle right now. But anyway, we're up against the upper bounds of this base. Like we're showing right here, this gray rectangle that we're using to mark resistance or the base breakout level. We're right there. So I think this one on any strength from here, on a violation of these pivot highs, buy all day. This is the kind of pattern we're talking about when we say a completed reversal pattern. That's what those 4 criteria that I was showing in that chart earlier today are measuring. A chart that looks like this and is resolving higher. So this one is kind of in rare company these days.
Actually, my mistake. Pinterest, I didn't realize, has been profitable for several years now, and this is actually looks like their 3rd or 4th quarter in a row, or even 5th quarter in a row, where they blew away the estimates there. Yeah. So
this one
they're on a bit of a streak.
This one gets mentioned a lot in M&A, right? So the fact that there's an activist in there, who knows? Who knows what kind of conversations are being had? But this one is mentioned as a takeover target. Other firms all the time.
It's not that large a company. What's the market cap? Can't be more.
I like this. Not even for a trade, but
it's bigger than I thought. $16 billion. Bigger than I thought.
I think a completed reversal here. This one's very viable. What else?
All right. The big loser of the day is Sarepta, SRPT.
The stock is still around, huh?
Yeah, it's still around. And so the chart does not reflect this, but the stock is down about 50%, 50%. I'm sorry, 48% now today, because of news regarding their drug for Duchenne muscular dystrophy. This is a drug that's been in the works for years. I've been following the stories for like 6 years at this point. What happened was they reported trial results, and while the drug did appear to work in some way, the improvement was not statistically significant enough to pass the results for the test in the trial. So this is a drug well, like I said, for Duchenne muscular dystrophy, which is itself a pretty rare disease, I think only 50,000 people in America have it. And of those, about 20,000 are children. This drug is already approved for, I think it got emergency use authorization for children's ages 4 to 5. They were trying to get it approved for a much wider range, age range in kids. They're still going to go for that approval, I think. But yeah, obviously this is Sarepta. This is their thing. This, like I said, for years and years and years. And so, the implication perhaps that the drug did not work as well as was hoped, and maybe they will not get approval for a wider age range in patients is why we're down here today, big time.
Yeah. So
just not a good headline for anyone, people who suffer from this disease or people in the stock or anything. This is just not a good headline. Not what you want to see.
So this one, over the years, earlier in my career, was a favorite among the biotech traders and the biotech junkies. Chart looked great back in the day when you had that base breakout. We've drawn a polarity zone with this gray triangle. We are below it today. Lowest level since like 2018, almost 6 years. So the stock has done nothing. It's traded in a massive range between like 60, 70 and $175 since 2018. And now it's resolving that massive, massive range lower, telling us this was a distribution pattern, a giant top. Who knows how low this one goes? I think that's their only drug, right? Like that's their thing, the muscular dystrophy. So this is a very binary vehicle at this point, right? It's either going to work or it's not. It's going to be a couple $100 stock or below 10.
Yeah, it's below 50 here.
Absolutely.
I'm sorry, it's below 60 here this morning. It's at 57 right now.
And we probably shouldn't have done a weekly chart here, because go look at this chart yourself, pull up a daily, and look at these monster gaps just over the past few years, gapping up, gapping down, and ask yourself, is this a stock I really need to own? Like, there's other options out there. There are other great stories. I don't think you need to own these stocks that can just, on a press release, plunge 47% in the pre-market. The problem is there's zero way to manage that risk for anybody. Mm-hmm. And not all stocks do this. This is actually something that is, very unique to the biotech space. It's a headache. I don't think most traders and investors don't need to put up with this kind of thing.
I actually think you're right. I wasn't sure when you said this is their only drug. The market is certainly acting like it's their only drug, and I just looked it up, and yes, I think this is their only drug. They are partners on this with Roche, which does trade. There's an ADR in the U.S. It trades OTC. It's RHHBY, I think. Yes, so that's down about 5% today. A lot less liquid there, but Roche has the global rights to this drug. Sarepta has the U.S. rights to this drug. So yeah, just a punishing headline here. By the way, this drug, as it stands now, Sarepta charges $3.2 million for this to use this drug. So it is wildly expensive. But
people want to hear about the Cameco report.
Oh, okay. I have something to talk about uranium. So, yeah, we can talk CCJ. I have some. But yeah,
this really isn't a great beat, though. You got to. All right, go ahead. Give me the numbers, and we'll talk about
it. Let's see. EPS 24 cents. Sales 428 million. How does that compare to estimates? Really fast. Let me see. Cameco CCJ. Come on, big guy. You can do it.
Top line, not great. Right?
Sometimes my computer just doesn't want to cooperate. Yeah. I don't know. I don't know if we have a CCJ chart. If we don't, can we get one real fast? Yeah.
So okay. CCJ, industry leader in the uranium space. This is like the report you want to read for insight in that industry. And today was earnings. So what I'm seeing, and Spencer, correct me if I'm wrong, we'll just move forward here. What I'm seeing is a massive beat on the bottom line and a massive miss on the top line. You want to see companies like this, simple business model, right? You're producing uranium and then selling it. You need to beat on the top line. When I see a top line miss like that and then a bottom line beat, that's accounting, right? That's below.
Yeah.
That's accounting stuff. That could be anything, right? You got to dig into the report to figure out, okay, were they cutting costs? What happened here? How'd they beat so big on EPS? But everything flows from the top line, right? If you have revenue beats, then you figure out the bottom line. If you don't have revenue beats, but you're still beating on the bottom line, like you're kind of pulling some levers, just like we talked about with McDonald's or anything else, right? Well, that was a little bit different with McDonald's.
Yeah. So this is highly unusual. I don't know if I can remember a time where a company, their EPS, they beat the estimate by 100%, right? 24 cents versus 12 cents, and their revenue missed by almost 50%.
That's what I'm saying. This is a report you would have to dive into and figure out, okay, what happened here, right? A little bit unique, but again,
I mean, there's a reason we say top line, bottom line. It's because it all flows down from the top, and the top line is the revenue, and it all flows down from there, right?
And Spencer, what's more important, a top line beat or a bottom line beat?
It depends on what kind of company you are now, doesn't it?
Always top line.
No. There have definitely been times where for certain maturing tech companies that they want to see bottom line growth, bottom line profitability. Uber comes to mind, right? These wildly unprofitable.
No, stop. I'm an accountant. Okay, done this for a long time. Okay, you want the top line beat. The bottom line you can figure out. The top line is so much more important. Wall Street will reward you more for top line beats. Bottom line stuff is manufactured.
As a general rule of thumb, yes, there are instances where
it's possible. I can't help either of you. I got to be honest.
Come on.
Seriously. You're impossible to talk to. Move on. All right, so that's it for uranium. Great question, Curtis. We are watching uranium stocks. They continue to trend better than pretty much any other group out here. UEC does stand out. Listen, I wouldn't overthink any one earnings report for these companies. I'll look into CCJ. We can talk about it more tomorrow. The point remains that these stocks are very well bid in a tape where most stocks are trending lower, not higher. Yeah. So the relative strength really stands out. I think of the beach ball effect. Okay, if the market is to finally find some sort of tradable low, rally into year end, you would think those stocks that are already showing impressive strength lead that rally. So uranium, yes, green light, we like them all.
Can we get slide 26, please? This is from a good Substack. I got
Ryan telling me about accounting. Today is amazing. I got to tell you guys.
Okay, hold on. This is from a good free Substack that I like called the ETF Shelf that I recommend reading. And if you're into ETF stuff like I am, look at the inflows into uranium and nuclear since COVID. And a lot of this I think is hedge fund driven. But that's not what this chart says. That's just what I've been reading. But just look how insane these flows are, right?
Look at the change in the narrative too, from uranium and nuclear equals evil to all these smart people and leaders and politicians coming out and saying, no, nuclear and uranium is not evil. It's actually excellent and clean energy, highly efficient, and we should use more of it. That's been the major seed change. Driving this trend. All of a sudden, the world is coming around, and rather than oohing and eyeing at the newest Chernobyl documentary on Netflix and talking about how terrible uranium is, smart people are coming out over and over and over again, whether it's Elon Musk, leaders overseas coming on saying, we need uranium, more uranium, we're bullish uranium. Uranium is actually good, not bad. And I think that change in perception, the change in the public narrative has opened up and given the green light to the space for institutions to jump in, everybody else to start participating. I think this is going to be a mega trend. I think this is a decade-long trend, and we're in the very early innings of it.
Riley says, how about those airlines? I'm glad you mentioned the airlines, Riley. Let's go to slide 23. We are tracking for a totally normal year as far as commercial flights are concerned. The top blue line is this year. You can see how it compares to the purple line, which is the last year before COVID. So completely normal year in terms of flights. And yet the very next slide, No one gives a crap. The Jets ETF is an absolute train wreck in terms of flows and performance. If you go to the next slide, right now, there we go. Thank you. No one gives a crap. In normal year and normal schmormal, these things suck. These things suck.
Where are you getting this data?
This is again from a good subset called ETF Shelf that I follow, and their data sources are they use a variety of data sources, and I think it says at the bottom where you can find this. So
send this to me. Just zooming out a little bit, context. Both JC and I would tell you, we really not only do we not weigh fund flow data much.
No, I know.
Weigh it at all.
I know.
In other words, just because something is seeing increased fund flows doesn't mean the price is rising. They're two different things.
Yes, you're absolutely right. But it does speak a little bit to the popularity of the idea. Something else I like tracking, is mentions of keywords. And if you go to the next slide now, this is a measurement of the mentions of the term AI in earnings calls among Meta, Alphabet, and Microsoft in the last two, from the most recent earnings call and the one before that. Slide 25, please. Sir. Thank you. AI. Did the AI bubble pop? Question mark.
What are you talking about? No, you're reading the chart wrong. They're all talking about it more than they were.
Oh, shit. Damn it. I read the chart wrong. Oh, man. Damn it. I read the chart wrong. Okay. Well, fine. The AI bubble was bigger than ever. That's what this says.
Did you hear this idiot on Bill Maher, Scott Galloway?
I don't watch Bill Maher. I try to avoid Bill Maher at all costs, actually. So, no. Well, what did he say?
I watched the Bill Maher. I actually find him refreshing most of the time.
Okay.
Scott Galloway, on the other hand, I do have his book because I like charts, but I disagree with pretty much 100% of the things he says. He came on to Bill Maher and he's a crazy California person. He came on to Bill Maher and he said, Ozempic, Wegovy, whatever, and Mounjaro, these GLP whatevers are going to be bigger than AI, have a bigger impact on society and the economy than AI. He's supposed to be a tech person, and I get it. He's looking for headlines, but man, that's just a crazy thing to say. That's just, you know what that is? That's just bad math.
I used to like Scott Galloway a lot, and then he sort of became like a hot take artist. And so now I don't really I don't really pay attention as much. But he used to have good takes like back in the day. He was like a measured guy, I thought.
He took a big swing on this one and whiffed.
Yeah.
So
he says some wild stuff now. This is just the latest one. So whatever. Okay, let's do Hot Corner real fast, and then we'll bring on Patrick here because we do have a very interesting transaction to discuss today in Hot Corner.
All right.
Hot Corner. So hot right now.
Yeah, so Overstock.com, Marcus Lemonis of CNBC fame, got to say, he owns a business down here on Duval Street. He bought one of the key lime pie businesses. I think I've told this story before. But he ultimately transformed it into a CNBC store, like the ones you see in the airlines. You walk in, and it's just replaying his episode of The Prophet from like 8 years ago.
It's great. Lovely.
Loop. And it's the worst key lime pie on the island. But it's interesting to see him make this big buy, more than $500,000 in Overstock.com. And at this very same time, you're getting bullish flow in the options market. So was it him? I don't know. Is he a big owner of this? I know that he's involved. Overstock.com, this is the furniture store. I think, Spencer, you were...
This is furniture. This is Overstock and Bed Bath. This is the new Bed Bath.
And it looks just as bad as the Bed Bath chart did.
No, it doesn't. It looks a whole lot better than that. But yeah.
So okay. I'm reminded of a thing I said about 5 minutes ago about Sarepta. Zoom into this chart. Start at COVID. You don't even need to go all the way back. And just look at the way this thing trades. From 2 to 100, back to 15. I mean, again, you want to ask yourself, is this a stock I need to own? Do I want this headache? Do I really need this in my life? I would argue no, especially for a stock that does something that does nothing special. OSTK. But it is interesting to see both the options activity and the insider buying at the same time. Again, so many charts are just so broken right now. If we were to zoom in on Overstock, you couldn't in good faith find a reason to buy this from a technical perspective right now. So, Keurig Dr. Pepper, I also want to talk about. Do we have that chart? So that's KDP. I think this is just a good example of the environment for low volatility stocks, right? This is the tape for staple stocks. Keurig Dr. Pepper is not like a unique situation. Oh, JC was asking what stocks are we shorting? We shorted this one and killed that trade. God, it hit our target so fast. So, these are the kinds of tops. These are the kind of patterns that you could sell. Obviously, the moment has passed. This top completed months ago now. But if you flip through the staples components, price structures like this are what you're going to see. These stocks have been absolutely decimated. You could say the same thing for utilities, the same thing for real estate. Showing a little bit of evidence of bottoming, maybe the past few weeks. You're getting a little bit of relative strength there finally. Not saying much considering how the broader market's been doing. But these charts are broken. These charts are broken.
That looks like a nice bounce off the lows to me. Wicked bounce.
Yeah, it's a monster oversold bounce, right? You're bound to get that. When you're sold off so hard like that.
Yeah.
So all of these groups, these defensive sectors, are worth watching, and it's interesting, right? Because we've talked about this before over the past few weeks and months, that you're probably not getting the same level of just super clean information about risk on, risk off from these groups like you traditionally do, because they're moving so much with the bond market. In other words, as rates keep screaming higher, treasuries aren't the only things getting slaughtered. These bond proxies, these high yielding groups are getting slaughtered too. And that's really being driven more by bond market volatility than it is by, offensive positioning, right? It's not like investors are throwing these out to go buy high beta names. That's not what's happening. They're throwing them out because the yield is too much better in the treasury market.
You're right. All right, let's move on, Pat.
Thank
you. Yo.
Good morning, sir.
Good morning. Oh, we got this.
How we looking?
Nice.
Steve's annoyed today because JC and I are disagreeing with him about minutia things. Well, not minutia, actually.
You guys just sound like a bunch of babies. I mean,
I agree. I was agreeing with you, okay, about the bull market thing. I was agreeing with you.
I heard you guys disagreeing about the top and bottom line thing, and it's not the first time I've heard you guys have this disagreement. So
don't listen.
Probably won't be the last either.
I'm not having a discussion about it. I'm telling you guys. Sorry. But it's top line that matters. Bottom line can fall into place, and good operators can figure it out. I'm not going to argue with you guys about things that I know.
Okay.
Like the market is collapsing right now. It looks as bad as it has since this time last year. On a
yes. So now that JC is gone, can the three of us agree that the bull market, if you want to call it that, is certainly weakening here? Can we all agree on that?
It's weakening in like a dire way. Like, we're on the brink here. Small caps below those prior cycle highs. I think the bull market thesis is like this close to being thrown out. Period.
I completely agree with that. It is definitely getting harder to make the case that we're in a new bull market. But we are kind of on that hinge. It's really, really kind of put up or shut up kind of level for a lot of these things, not just the S&P, like you mentioned, Steve. Small caps, financials. I mean, we could go down the list, but almost everything's at a really critical level here.
Like, they can come out and save it, Pat, and I think that's what you're saying. But like, we got to see this now,
right?
Like ASAP, right? Like, we were talking about how it looked like they were reversing those tops at the beginning of the month. That all fizzled hard. Now we have new lows. Look, we have a series. Just look at the S&P. We have now a pair of lower highs and lower lows. So like a downtrend is forming very clearly in even the strongest indexes. You can't have another set of lower highs and lower lows without having to say, okay, then next stop is the October lows from last year. And at that point, small caps are probably so blasted that the majority of people are getting absolutely hosed in their stock portfolios.
Well, and that's the point that this chart is trying to make, right, Pat?
Yeah. Yeah, I wanted to keep it super simple with this one. Just, here's the level we need to reclaim. This is kind of at the top of the Bulls to-do list this week. But, Steve, I think that's a really good point, but at the same time, what do you make of how quote unquote normal this correction has been in terms of, first it's lasted a little longer than the average correction, but it is kind of around, 10, 11% there. So what do you think of that? I mean, going into August, everyone was saying, okay, we're probably due for a pullback or correction, something like that. And then it happens. So, do you think that this is just that, or you know what I mean?
So when you look at the major averages, the large cap averages, you could say, okay, this is garden variety, right? This is pretty standard corrective action, right? You talk about, okay, where the NASDAQ came from, right? This is NASDAQ 100 we're looking at. Look at where the NASDAQ came from. Best beginning of the year, best first half of the year in history, deserves a little pullback. But you can't just analyze these corrections in a funnel, right? You have to, or a tunnel. You have to look at what the broader market is doing and what is other evidence suggesting, right? So I think it'd be easier to say, oh yeah, this is really standard, not really a scary corrective wave for the large cap indexes in an environment where small caps weren't absolutely collapsing and taking out key levels, right? If these other things weren't happening that we have to point to, oh, transport's making new 52-week lows.
Yeah.
Every sector in the world completing, a really ugly topping formation, right? If all that other stuff wasn't going on, then yeah, you could look at like the 10% pullback and say, whatever.
Yeah, no, that's a really good point.
Yeah.
I think it was Dean Christians. I didn't include the chart, but he pointed out yesterday, he was like, if you're going to use semis as your kind of bellwether and also transports, you got to be paying attention to transports here because semis are holding up a little better, but transports are sending a pretty ugly message there.
Home builders too. It's getting whacked.
Oh, yeah.
A lot of these pro-cyclical groups, right? You would throw transports into that pro-cyclical basket with home builders, semiconductors, banks. So too many of these traditionally risk-on or offensive areas that need to and should do well in a bull market, not doing well, showing what's becoming more and more longer-term technical damage, right? Are you starting to see that? It's not just tops. Now it's these massive range resolutions, something like small caps or micro caps, but something like a longer term deterioration in the technical outlook. You never want to see that. I think that Riley asks a good question here. If you're going to get a scoop and score, that's the kind of formation that needs to happen really quick, right? It should be a quick whipsaw or shake and go move. You don't want to see something hanging out down here at the lower bounds. Typically what you'll see is a downside resolution, right? An environment where that were to play out longer over time. A little shake and go, that's how the best failed moves are kind of sparked. So
that reminds me of something so Andrew Thrasher, his latest Dow paper that he won was kind of looking at that idea of the speed of corrections and pullbacks. And he found that, I mean, you should go read the paper, it's free, but basically the faster a 5% pullback happens, the less serious it tends to be, But if it's kind of the slow bleed, that's worse. And I mentioned this correction is lasting longer than average, so that's something that's not great.
Yeah, for a scoop and score or any sort of failed breakdown, you want to shake and go, like you really want that whipsaw shakeout move, and you want it to happen really quick. If it's hanging out, then it's digesting the move that it just made. Probably going to keep following the tactical trend, which is lower now for a group like small caps. I think just overall, like an important message that I would like to share with everybody before we go is you don't have to constantly be long or short stocks. You don't have to come out here every day and buy or sell something, right? Yeah. We also have the option as investors and traders to do nothing. And a lot of people forget that, especially people who, tell themselves that they're trading for a living or trying to trade to make, XYZ amount of money, right? It's okay, I have to come and participate in the market every day. No, you don't. A lot of times when the market is as messy as it is right now, or breakouts aren't sticking, the best thing you could really do is sit on your hands, go fishing or go golfing, right? Just wait.
I will reiterate that. I think the biggest change in my trading came from realizing that I don't have to go out there looking for trades. I should say no as much as possible and wait for a trade to be so good, and for me to actually have conviction about it, that it would be irresponsible to say no to the trade. You know what I mean?
And that should happen with any good trader who's paying attention to themselves and their process over time, right? Like, I know myself as a trader by now. I know the kinds of environments that I'm going to come in and do really well in. I know the kinds of environments that are conducive to my process, and I will push the gas and I'll be all over trading all day, every day in those environments. But I've also learned over time the kind of environments where I'm more likely to lose money than make money in, right? And I'm very familiar with those environments now too. So I'm happy to say to myself, this just isn't my mode out here. This isn't my vibe.
I'm gonna go fishing.
Golf course. So it is important. Sometimes you could just do more harm than good in environments like this. So I think that's important for everybody to remember.
Very well said. Very well said. And then I'll add, just in the coming days here, 2 big headlines that have the power to potentially turn things. You have a Fed tomorrow and you have Apple on Thursday, right? And both of those things could potentially, go a little ways in changing sentiment. We'll find out though. But
I wouldn't say that for Apple, right? Apple's their own thing.
I don't know, man. It's the biggest stock in the world.
I know, but Apple doing well isn't like a read through for the broader market. Like, oh shit, people are still buying iPhones. No shit. You know what I mean? Like, it can buoy the indexes, Spencer, if that's what you're saying. 100%. Like, it can make a difference for the S&P and the NASDAQ, but the broader market's going to have to get their shit together, and individual components are going to have to find their own lows without Apple doing it for them.
Steve, what do you think of this Head and Shoulders in NVIDIA that everyone and their mother sees?
Which one? These little tactical tops? Or in Apple?
No, this one formed over the summer. I think it's like 3 months.
Apple?
NVIDIA.
Oh, NVIDIA. Yeah. Listen, again, you can look to a lot of semiconductor stocks that look so much worse than NVIDIA. NVIDIA remains by far one of the strongest ones. I think it's literally near new all-time highs right now versus semiconductor index.
Yeah, I mean, best performing S&P stock. It's certainly, it had that breakaway gap in May and hasn't retested the breakout zone yet. And that created the whole AI frenzy, that move, that breakout. So
I think the closer you can get this one to that gap, Pat, which is right around 370, the better. Right? I don't see that gap being filled.
You don't think it will? I mean, the best breakaway gaps don't, right?
I don't think so. And there are so many buyers just waiting for an opportunity to get into this thing. Right? If we were to revisit that big earnings day gap from back in, May? I just think people will be pouring in from the sidelines. There's a relentless bid for this stock.
Yeah.
Yeah, I think, listen, there are better ways to lose money than trying to get cute and short NVIDIA here. This is the stock that everybody wants to own. Do you really want to short this thing and bet on some sort of a topping pattern? Again, crazy.
I will say it is below that neckline though, down 4% today. So we'll see. But I agree with what you're saying there.
We gotta wrap this thing up. What are you gonna be for Halloween tonight, Pat?
You're looking at it. This is scary enough.
JC's dressing up as a permeable. What are you gonna be, Spencer?
A mover. How about a mover? Because I gotta pack up my apartment, so I'll be a mover tonight. How about that? We'll go with that.
All right.
One thing I've learned as I've gotten a little older is not to offer help to my friends when they're saying they're going to move. I know that sounds mean, but
fortunately for me, I've done the offering in the past, so I am now owed quite a few favors on that front. So
there you go.
Yeah, I played the long game for this one. So.
There aren't many things worse than moving. So say a prayer for you, Spencer. It'll be okay.
Nah, this one, if you could outline an ideal moving scenario, it would be this one. I have a few things working in my favor.
You're not going far, right?
Actually, I'm going like an hour, but I don't have to be out of my current place by any specific date.
Nice. Yeah.
So I'm not I'm not being evicted by the end of the month, which is today. But so I can sort of move in pieces if I want, right? So yeah, anyway, that's what I'll be doing this week. Okay, let's wrap it up here. We have Spaces coming up in about an hour, 11 a.m. Eastern time. We also have Chart Request live at 1 o'clock today. Stay tuned for that. Email us your requests. Email us any feedback at all. Questions at stockmarketmedia.com. Thanks to our guests today, Katie Stockton and Pat. And thanks to all of you in the chat. We'll see you guys later. Go make some money, all right?
Thanks,
Cheers.
guys.
Oh, and happy Halloween to all those
Happy
who
Halloween.
celebrate and trick-or-treat and do all that good stuff. All right. Peace.
Cheers.
Run it. I can't take no loss. I don't even know what it